It's February 14th. Happy Valentine's Day. Amazon reported a decent earning last week with 6% underlying growth. That was at the lower end of its guidance of 6 to 8% given in last quarter. As we can see from this table, its safety and productivity division had a 10% sales reduction compared to 1 year ago. That was the main reason of soft sales from last quarter. However, its adjusted EBIT margin came in around 22.7%. That was up from 21.4% 1 year ago. So the profitability is still healthy. The management raised the guidance by 1 percentage point, supported by increasing backlog. They also bought back shares in the amount of $2 billion in the last fiscal quarter. The management indicated that they are done for this fiscal year, no more share buyback. The reason being that Amazon is busy with portfolio management. As I mentioned before, it's selling its climate tech segment, and right now the management wants to use the proceeds from the transaction to buy other business. Because of all that transactions, it is difficult for me to understand its valuation. Maybe when I get time after this earnings season, I'll deep dive into its valuation. But for now, I just keep monitoring its underlying business, which is healthy and in a holding pattern related to its stock. JFrog also reported the earnings last week. So in terms of earning growth and sales growth, you can see in the chart on the right that its sales in fourth quarter last year was on trend. However, the management gave a very pessimistic guidance for the current fiscal year and current quarter. You can see in the chart on the right, the guided sales in the first quarter is significantly below that. You can also see from the chart on the left, the estimated sales in 2023 is 22% higher than last year, which is a significant deceleration from 36% and 37% growth in the last 2 years. The management attributed the deceleration to the macro economy. The trailing 12-month net dollar retention was 128%, which was pretty healthy. However, the management gave a guidance of 120% at the end of this year. So that's a sizable reduction because management assumed very little upside from the current minimum spending commitment by its customers. So I believe that guidance is conservative, and the company will have a potential to surprise to the upside. Now let's look under the hood to understand JFrog's business better. So as shown in this table, in the fourth quarter last year, the Enterprise Plus product generated 43% of total revenue. That translated into $32.9 million compared to $43.6 million from other products. So comparing to 1 year ago, the Enterprise Plus revenue was $20.7 million, and the other product revenue was $38.5 million. So enterprise product revenue had a growth rate more than 50%, and the other revenue had a growth rate less than 10%. So the adoption of its Enterprise Plus is driving its revenue growth. As we can see from this chart, the Enterprise Plus include many components. So that will increase the switching cost for its customers to products offered by its competitors. Therefore, I think JFrog is widening its moat. On the flip side, it has a land and expand model. So it is important to see other revenue to grow because many smaller companies will land with the lower tier products first, then migrate to Enterprise Plus. So this is something to monitor. Ingredient reported a very good fourth quarter result. Its sales from last quarter grew 17% year-on-year on constant currency basis. This high double-digit increase is impressive. It's mostly because of its pricing power could pass on the higher corn cost, which was 18% higher. So it's even more impressive to look at its gross margin actually expanded by 120 bips from 1 year ago. That means Ingredient not only just pass on the cost, it actually increased its gross profit with the higher amount of sales. That tells me Ingredient actually benefited from inflation. Not many companies can say that. We can see from the stock market, many company stocks suffered because of the higher inflation and the higher interest rate. So as a result of sales growth and margin expansion, Ingredient adjusted operation income grew almost 60% from 1 year ago. Its full year earning per share came in around $7.45, so at $98 per share. Its PE ratio is about 13, which is fairly attractively priced. And for 2023, the management guided the EPS in the range of $7.7 to $8.4 per share, likely another 10% increase, again benefiting from inflation. Last year, Ingredient spent about $368 million on capital expenditure and M&A, paid $176 million in dividend, and bought back shares for $112 million. So we add all that cash outlay together, it's about $750 million. So does Ingredient generate enough cash to cover all that cash outlay? So we can look at the CFFO in this table. In 2019, it generated $680 million. 2020 generated $829 million. In 2021, $392 million. That's significantly less than the previous 2 years because of a higher corn price and require cash to fund its working capital for about $250 million. For 2022, CFFO was $152 million, with $620 million diverted to working capital. So for 2023, the management gave a guidance of a $200 million diversion towards working capital, with $600 million of CFFO left. So I would say its cash flow situation is still healthy. Once the corn price stabilizes, its sales and EPS will likely stabilize too. However, it will release a vast amount of working capital and use that cash flow back to fund the dividend and share buybacks. So at the current price, I think Ingredient is undervalued. Equifax reported a fairly decent fourth quarter considering the mortgage headwind in the industry. So in 2022, 56% fewer mortgage originations compared to 2021. Despite that, its full year sales grew 4%, gave a guidance of another 4% growth in 2023. That core growth is strong despite the foreign exchange rate impact. So we can see from the chart at the bottom right. In the first quarter last year, the core growth was 21%, and 19% in second quarter, 16% in third quarter, and 10% in the fourth quarter. The mortgage headwind resulted -9 to -14 revenue impact in the 4 quarters in 2022. However, its EBITDA margin was still strong, despite the high margin mortgage business was declining fast. The management gave a guidance of 36% EBITDA margin in fourth quarter of this year. That's a significant step up from the EBITDA margin in the last 2 years. So that is good news and shows its strength in its underlying business. So let's examine the growth drivers of Equifax business. Its vitality index has been increasing and reached 14% in the fourth quarter last year. For 2023, the management gave a guidance of 13% for the full year, compared to 10% long-term goal. So its innovation is generating significant new revenue. Another growth driver is its workforce solutions. So we can see the company continues to increase the number of records in its database to 152 million at the end of last quarter, with increased number of data contributors compared to previous quarters. So both are trending in the right direction, bodes well for future growth. Equifax added $450 million of run rate revenue from acquisitions done in 2021 and 2022, including Logics and Mitigator acquired in the third quarter last year. The company also announced the BVS acquisition to be completed in the third quarter of this year with $160 million of run rate revenue. So its M&A pipeline is strong and healthy, which indicates good future revenue growth. So my investment thesis has now really changed. At the current price, about $205 per share. Its EV over EBITDA is about 17.1 if we use the estimated 2023 EBITDA of $1.8 billion. To me, that's a fair price for a very good company with a reasonably good growth prospect. The management gave a cautious guidance about the mortgage market in 2023. So we can see from the chart on the top right. In the first half of this year, management saw a 44% reduction in the number of mortgage increase, but that will improve to -7% in the second half of this year, which is about a 30% reduction from 2022. However, the mortgage market is now only about 24% of its total revenue. So the growth in other segments will outweigh the headwind from mortgage market headwind. The management also indicated that 54% of its revenue is recession resilient. So I would conclude my review by saying that Equifax has a healthy underlying business with good growth prospects and a reasonable price given the environment. If its share price has a significant pullback, I plan to add to my position. This concludes this latest episode of Quest for Twice. Until next time, happy investing.